Just to welcome our panel members, and I'll start over on my right-hand side. So we have Sean McGovern, who's Chief Compliance Officer and Head of Regulatory and Government Affairs for XL Catlin. We have Stephen Finlay, who is Head of Prudential Regulation for the Association of British Insurers. We have John Huff, former Director of the Missouri State Regulator and immediate past President of the NAIC. You've already been introduced to GERRY. And finally, Dr. MANUELA ZWIMUELLER, Head of Regulations of EIOPA. And there is more detail on each person's bio within your conference pack if you want to have a little bit more of a read around that. As Manuela said to me last night, she said, I'm now into my 6th year of my 5-year stint in EIOPA. So I think for many people here, they're long of industry and long of regulation as well, so across both sides of the fence. I suppose where we should probably start is probably where GERRY left us off was probably on Brexit. And maybe, Stephen, if I could go to you firstly, and maybe just get that perspective from the UK industry around what is the sentiment like at the moment, and what is the industry trying to push for in terms of what they see as being the future outcome of where the UK will sit vis-a-vis Europe?
Yeah, sure. Thanks, Glenn. And maybe I could just firstly say that on a personal note, it wasn't the outcome I was looking for during the referendum last year, and certainly not the way I voted. And as an industry and as the ABI, we publicly sort of went on the record as supporting the Remain outcome last year. But nonetheless, we are where we are, and we're now sort of working as hard as we can to secure as good an outcome as possible for insurance customers, for our industry, as well as the broader UK economy. There's far more questions than there are answers at the moment, and that uncertainty is certainly not helpful. I think GERRY was quite right when he hinted that it is extremely likely that the UK will be leaving the single market with the Prime Minister prioritising control over immigration and leaving the jurisdiction of the European Court of Justice as her two main areas. And so the UK industry is really now activating its contingency plans on a sort of hope for the best, plan for the worst basis, I would say. What does the worst look like? I think it looks like no single market access, no customs union access, no equivalence assessment, and also potentially no transitionals or phased implementation, depending on the jargon that you wish to use. And so that means seeking to restructure and relocate so that we can continue to service existing contracts as well as write new business in the EU27 jurisdictions. But there's also a big issue for EU27 based firms looking to passport into the UK, which is currently a very non-trivial part of the UK motor market in particular. So those are some of the challenges. Restructuring and relocating are some of the possible solutions which firms are looking at, and many, of course, have already announced their intentions, and more are in the pipeline. As there's a big timeline issue here, the industry can't afford to wait for 18 months, 2 years until we have that certainty, and therefore are needing to sort of act now on that worst case scenario. We then need to think about what the future prudential regime in the UK looks like, and we can maybe come on to that and discuss later on, and how that would interact with, be different from Solvency II and some of the international developments we see as well.
And just on your point around timeline, in terms of your sense of your own members, in terms of that phase of going through the sort of the contingency planning to the actual activation of plans, are we still at a sort of a stage where some people have activated, but a lot of people are still in we've looked at the contingency planning, but we're not yet activated? Where do you think we are in terms of your members?
Yeah, I think that's right. So some have, very much, pressed the button, made their announcements, and are now proceeding with that. Others still considering their options. But over the course of the next few months, I think we'll see more activation, as you say, of those plans, not least because of the long lead times required to fully fulfill them, particularly if you need to do the likes of part-driven transfers or set up and get regulatory authorization in different jurisdiction. There's another incentive here, I think, to move sooner rather than later, which is just the sheer bandwidth which will be available, and getting in that queue soon enough to ensure that you can come out with the structure and the authorizations that you need prior to March 19, if it is going to be quite a cliff edge, hard Brexit that we end up with.
Yeah, I think that's an interesting point that Gerry, you didn't necessarily mention within there, but actually the operational capability of each of the regulators to actually handle applications will be a deciding factor for some people in where they end up going in terms of, can I actually get authorised in time? And I think that's going to be a big issue for people who leave it too late to make clear decision making, or where uncertainty prevails. I suppose taking on that theme, Manuela, in terms of just looking at it from EIOPA's perspective, like Gerry mentioned quite a bit around, I suppose, the level playing field and the role that EIOPA has to play, or the European institutions in general have to play in terms of ensuring that that transition of UK entities across into the European Union, that's done in a fair, balanced, but also efficient manner. How do you see EIOPA's role within that?
No, thank you, Glenn, for asking this question. So I fully agree with Gerry. So there are a lot of challenges ahead of us. There is also a timeline issue. I fully agree. So we, as EIOPA, see a role here, and we also picked up the challenge. And that means that we are really striving to ensure that those UK groups that are relocating or intend to relocate, that they fall under a proper supervision. This is really key to us. We won't accept empty shells or letterboxes. I think this is a very clear message from our side. So we strive for sound supervision, which means, and this is also what Gerry said, appropriate location of management and key functions. So we won't tolerate that, there is something but nobody's there, so there is an empty house. We also will require a sound outsourcing policy. So that means that we are not going to accept a full outsourcing of key areas. And also on fronting, because that was also recently in the press, we are not going to have fronting without any risk retention. I think these are three very clear points, and I would also like to emphasize that our board is really also united to the aspect that we don't want to have regulatory arbitrage. We want to ensure the level playing field and the fairness, and I think this is also where customers at the end will benefit and the policyholders. And from the EIOPA side, we therefore we are now putting our resources on three steps. First of all, the supervisory team that also Gerry mentioned, we are going into those and see those national supervisory authorities who are either chosen or most probably be chosen to receive those firms from the UK that will relocate. We look here how, for example, authorization is done. We look at the criteria. Here we are really also analyzing the evidence that is provided to us. So that's the first step. We look quite closely at this. The second step is we will issue quite soon guidance on sound principle of authorization and supervision. And thirdly, EIOPA will certainly monitor this guidance that we gave very, very closely to ensure this level playing field. So I think we are in the middle of these preparations, and I think it's really also important for a sound supervision and a healthy market on insurance and reinsurance.
Very good. We might step away from Brexit for a moment, because I know there's a later panel on Brexit as well, and probably to open up a bit wider from a global perspective. And in many ways, some of the things that we're seeing from a Brexit perspective, particularly on the political side, echo in the US in terms of what we're seeing from a Trump point of view. Be great, John, to get some perspectives as to, what is the current state of affairs in the US and how is that impacting on the insurance sector?
Sure, thanks Glenn, and thanks to you and Deloitte for the invitation, and Insurance Ireland for the invitation to be here. It's nice to come several thousand miles and you think you may not know anyone, and you walk into the room and your breakfast is sponsored by RGA, a Reinsurance Group of America that's headquartered in my state. Or I look across the street and Enterprise Rent-A-Car, which is one of the largest car for hire entities, which is headquartered in my state. So I feel very much at home, not the least of which my mother's maiden name was Downey, which the Irish have made me feel very welcome. But I do think this is beyond Brexit. There is a movement afoot, whether it was the June 23rd vote in the UK last year for Brexit, or whether it was the November election of Donald Trump in the US. And where I think that's coming to come to fruition, one of our U.S. Federal Reserve CEOs, everyone knows about the Federal Reserve Bank in Washington, D.C., the board, but there are also 12 regional banks. And in my state, Missouri, we're the only state that has 2 of those Federal Reserve banks, in St. Louis and Kansas City. One of those CEOs said in January, after the inauguration of Donald Trump, said, "The era of regulatory expansion is over." And I think we have seen a sea change in regulation, and those 2 elections have really had a kickstart of this movement. We're seeing a look toward nationalism and protectionism and inward looking, and for the last several years we've been working collectively on using words like convergence and international standards, and I think this is a sharp turn from that. And we'll see how that moves forward in our work, but I think it will be a reboot, if you will, for many of the international standard setters, and forcing them to remain relevant and to be at a higher level in coordination. Let me give you one brief example, if I may, of how this is, we're seeing this manifest in the U.S. In the U.S. today, we are having a serious debate of whether we will have a cross-border adjustment tax for anything that's imported into the U.S. And at the current time, it has not been decided whether financial services would be excluded from that. And if financial services is included, it's not clear whether reinsurance would be included. So at this time where the nation is looking inward and being more protectionist, we have a very global insurance market in the U.S. About 60 to 65%, depending on the year, of our natural catastrophe risk in the U.S. is ceded to international insurers and reinsurers. And regulators, state regulators, want it that way. They do not want the concentration of the U.S. nat cat risk but with U.S. companies. A border adjustment tax could end the beauty of that diversification. And right now the discussion is having up to a 20% tax for any reinsurance that would come into the U.S. It could substantially change the reinsurance market. It is a big issue, and it's one I think deserves more dialogue.
And that risk, I suppose, of really losing some of what is a key part of the marketplace, which is diversification through, I suppose, regulatory and national borders, effectively creating concentrations of risk is a real valid risk for us as a global economy and a global marketplace.
Absolutely.
And Sean, just to pick this up in maybe more from the company side, when you look at this in terms of sitting in a global organization, looking at the regulatory borders coming up, I think we talked about that point of saying, well, actually, we were moving on this harmonization or this globalization. I think your view is we weren't quite there, really. We were in a lot of places. How do you as an organisation try and prioritise which are the areas that you need to focus on from a regulatory team, and what are the challenges that creates in terms of saying, well, is it Brexit today, is it the US tomorrow, when you have that footprint across the globe?
So I'd very much agree with what John has said about the where we are in the regulatory cycle. I think there's two things going on here. One is protectionism, nationalism growing. We've seen it for a long time in many parts of the world. I think it's concerning that we're now seeing it in the world's largest economy, and I think that will risk more protectionist approaches being taken, which for our industry is precisely the wrong direction because we're all about diversification of risk. And the second thing that's going on is this question mark over, whether or not we are deregulating in certain parts of the world and how that is going to play out. So I think what we're in is a different period of regulatory uncertainty than we've experienced. We've been through the post-crisis regulatory build-out, which has been going for 10 years, and we're now at a point where the regulatory uncertainty isn't being caused by regulatory expansion, it's being caused by regulatory divergence and differences. And for a global organization, that means the burden of regulation is actually increasing. So I'm all in favor of convergence if it creates efficiency in how a company is run, how a global group is run, and more importantly, how a global group is supervised. And there is a great merit in having efficiency through college supervision, etc. I do worry with increasing levels of divergence how we're going to get efficiency into the system. And I think we were on a good path to doing that. And I worry that some of the trends we're seeing not only threaten business opportunities, but will also add costs to the way in which we run our business, and will also have an impact on capital and how we can make sure we're deploying capital efficiency, making as much capacity available as we can, and being able, therefore, to serve our clients in as efficient a way as we can.
And do you see, Sean, is the colleges the potential white hope within that through the colleges that we will get that level of I suppose, cooperation convergence, or is it more likely that while that will give us some commonality, we will still have the different flavors of the same thing, and therefore you're trying to still manage multiple frameworks?
I think there is a challenge at the moment about what we as an industry and what regulators are trying to achieve through college supervision. So, colleges are not a new concept. They've been around for a long time. And I think the relationship building and the trust building between supervisors is incredibly important. And there's a huge part that companies have to play in helping to make that happen. I think we have seen new ideas, new consultations coming out of the IIS around supervision of groups. My fear, and we probably won't have time to get into it now, but my fear on that is we are actually going to see college supervision become more complex because there is a desire to try to raise levels of harmonisation in how colleges work, which is a laudable aim. But the potential expectations of college supervisors are going to just increase and increase and increase. And I do worry about whether we should let some of that stuff happen more organically rather than trying to force the pace by implementation of more rules and guidance.
Which is sort of back to what you were talking about, John, is that piece of the global supervisors will have to probably move up higher level from a principal basis, and we will have the national regulators having that piece of setting the agenda, and really through persuasion, really to try and get that convergence rather than through prescription of global standards.
I do agree with Sean that the colleges have a ways to go. And to be honest, we had some great US-EU dialogue going on with the EIOPA and the NAIC over the last 4+ years in a very concentrated way, and we've had dialogue, of course, for decades otherwise. But we lost the last 18 months or so. We're so focused on the covered agreement and some of the aspects related to that that we really didn't hit the college aspect. And the other thing about college is it's such a hard area to talk about publicly because it is probably our most closed group, if you will. It is the group that very small numbers and not everyone, of course, is allowed in a college, and they are company specific, so you wouldn't be talking about that at a granular basis. But I do think there's an opportunity. We talked last night at dinner of the complications that companies have now with the numbers of ORSAs, and you can probably speak to this better than I can, Sean, but there's work to be done, and maybe that's the best part of the EU-US dialogue. The next phase is focusing on the supervisory colleges and ways to make it more efficient, but also to allow for this organic growth, if you will, because the best practices from the colleges, I think, will come from the colleges.
Yeah, I think there's also an interesting point that comes out of some of this discussion around the real friction between the global operating models of organisations and that point that was being made, Gerry, around substance. You know, we talk about every national regulator wanting a certain amount of substance, but everything else in the globe pushing us to global operating models, be that, you know, cloud-based technology, be that mobile workers, be that whatever. Just that point on substance as to, you know, does substance always mean, you know, feet on the ground, or is it that combination of technology, decision makers, you know, consistent operating model across a globe?
I think that's exactly right, Glenn. That's exactly the challenge. And I think we try to be, and of course, you know, every case is different, so it's very hard to give sort of concrete answers. But what we try to articulate is that, on the one hand, you know, if we're authorising an entity in Ireland, you know, you want there to be enough there that the business is being run from here. So that's the first thing. On the other hand, you know, we all recognise that these businesses are part of European global groups, and there's significant benefits from that, and being able to leverage the benefits of that group, the overall group strategy, the technology, the expertise, the skills, all of that. So it's about, and I think, frankly, I think we're all, you know, and across Europe, we are working our way through this. And what, to my mind, is very important is that we sort of, as we take the steps, and it is moving quite quickly, because as has been said, the timelines are quite tight. But what's very important is that as we take each step down the process, we're always going in the right direction. I think that's the key thing. So you don't want to have a misstep where you're interpreted, you're either saying or you're interpreted as being saying, you know, oh, we're going to take a very harsh line on this. No, it's, you know, it's whatever you want to do. It's getting the balance right at each step along the way. And so for us, I think it's very important that we're able to say we're comfortable that the business is being run from here, that particular business. We're also very comfortable that it's well integrated in, that there's appropriate use of outsourcing, that there's appropriate use of quota share, that is leverage. So it's about getting it right, and I think we're making, you know, I think we're making very good progress. But it's a journey as well. Yeah.
It's a journey as well. Yeah. I do have a few questions coming in here, so I will ask a couple of these. Just to get us going as part of this. There's one here, John, for you around, you know, given that we're talking about harmonising regulations globally, should the US consider harmonising its own regulations first and that piece? So maybe give us your perspective on where we're at in a federal versus state perspective.
Well, it's an interesting question, and I also think part of the question talks about the lack of understanding of how state-based regulation works in the U.S. So when you think about the three entities that touch insurers in the U.S. for large measure, you think, of course, about the states, who are the primary regulators of insurance, and regulate on a legal entity basis, which is very important when we start talking about group supervision and group capital. But by the legal entities, the regulators, each legal entity is domesticated in a state, and the state regulator, commissioner, is in charge of that regulation for that entity. Now, collectively, the states are bound together through the National Association of Insurance Commissioners. I was president last year, and in that organization, we have an accreditation committee, which is the hammer, if you will. That may be a derogatory or a pejorative term that some people think, but it's the hammer that keeps the states substantially similar in their financial solvency regulation. And that's an area we've been successful at. We've had discussions with the EU as EIOPA starts assuming that role with the member states of keeping member states in line to be substantially similar in their implementation. So that's how we keep the states together. And then many people look to, I think some people misunderstood and sometimes people were misled when the Federal Insurance Office was established with the 2010 Dodd-Frank Act, thinking that they were going to be the super regulator, that they were going to be a version of EIOPA or the regulator that's in charge of the regulators. And in fact, Dodd-Frank is very clear. The Federal Insurance Office has no regulatory authority whatsoever. So they have a bully pulpit, and they have some responsibilities under Financial Stability Oversight Council as a non-voting member. I was a non-voting member at the Financial Stability Oversight Council. And there's some other responsibilities within Dodd-Frank. I'm not trying to minimize the Federal Insurance Office, but they have no regulatory authority. And then you go to the Federal Reserve, the third leg of the stool. The U.S. Federal Reserve has insurance regulatory authority, but over a very limited number of companies. Companies that organize with a bank, so to speak, a thrift holding company. That number is down now to, I think, 14 in the U.S. Most insurance companies have gotten rid of their bank, but there are still 4 that are substantial size. State Farm, for instance. So that's a substantial responsibility for the Federal Reserve for consolidated regulation, not regulation of the individual legal entities, insurance legal entities that remain with the states. And then finally, the Federal Reserve is responsible for consolidated regulation of the systemically important financial institutions, those institutions that have been named by FSOC to require an additional layer of regulation. Well, there's a great deal of uncertainty where that's going to go right now, because the Trump administration has said publicly they want to dial that back on the designations, revisit the designations that are already there. As many of you know, MetLife was in litigation challenging their designation. That litigation has been put on hold by mutual agreement until there's this working out of these SIFIs. So in large measure, I contend that there is a great deal of harmonization in the U.S. Now, people may represent their roles differently, but that's the way I represent the roles of the regulatory community.
Yeah. In many ways, there's similarities between how the European Union is working in some of those areas, in terms of that harmonisation piece. Which probably brings me on to another topic that we should definitely try and cover within this session, and was referenced earlier, which is Solvency II, and just where we sit with Solvency II. So maybe we'll take it from the company perspective first, and Sean, give us a bit of perspective as to what has it been like to go through, I suppose, the first Pillar 3 reporting anyway in terms of annual, and what's the sense from a company perspective?
So I guess we've been through the first full round of what actually Solvency II really feels like, particularly, as Glenn said, the Pillar 3 reporting cycle, which I'm guessing anyone who has been involved in that will know how much of a lift that has been for the industry. And hopefully that's because we're doing a lot of it for the first time, and maybe as it becomes operationalized it will become more efficient, but it has been a big lift. So having gone through the first full cycle of Solvency II, the question is, how do we feel about Solvency II now it's been implemented? And I guess, from where we sit, if you break Solvency II down into its 3 pillars, so from the capital perspective, there are question marks over, whether capital is being set at the most appropriate level, and there is a review of the standard formula SCR. It does feel as if we are living with the legacy of the post-crisis response, in that there has been a desire to have increased levels of capital as a consequence. And some people would argue that Solvency II has been partly a vehicle for trying to achieve higher levels of capital in the industry. You look at Pillar 2, I think everyone would agree that Solvency II has been a catalyst for improving risk management in the industry, unquestionably. I guess there's a challenge around, the expectations of boards around, their levels of understanding and knowledge about, how capital is set, how risk is managed, and some of the documentation that flows off the back of that. And you mentioned ORSAs. I mean, we are filing about 19 different ORSAs in different countries around the world. It does feel as if we're being pulled in multiple different directions. And I think, again, going back to the colleges, I think there's a real role for colleges to play to try to help harmonise those expectations, so supervisors get what they need, and a firm gets to deliver that in a more efficient way than currently exists. And then on the third pillar, we have a huge amount of reporting and data that has just been filed. And I guess the question is, what are the regulators going to do with all of that information? And is all of that going to prove useful in the proper execution of supervision? So I guess where I would summarize is that I think we need to be able to take a step back from Solvency II, realised that it was something that was implemented in the midst of a financial crisis or the post-crisis era, and have a mechanism that we can collectively, as an industry and as supervisors, look and see how we can prune the bush. So are there areas that are clearly not adding value to supervisors or to firms, and let's have a mechanism to weed those things out so we can get Solvency II to be a system that is really of value both to the supervisors and to the firms.
Yeah, I think you've brilliantly encapsulated what I would see as a similar sort of a commentary within the marketplace here around, you know, the added value that was taken out of Pillar 2, particularly in terms of understanding risk, but those questions around the burden of reporting and then the appropriateness of the capital model seems to be there. And I know, Stephen, you know, a lot of the commentary, particularly out of ABI, has focused as well on, I suppose, a lot of the things around transitional measures and how they have maybe, you know, muddied really our understanding of what's coming through in terms of sort of Solvency II reporting. Looking at it from sort of the ABI perspective, what are the things that it has struggled with in terms of going through that sort of Solvency II cycle and areas where it sees we need to look at and refresh?
Yeah, well, firstly, I think I would completely agree with sort of, you know, Sean's comments there right across all three of those pillars, and sort of very reflective of the experiences of UK firms too. From the UK perspective, I think we would say that, you know, broadly speaking, the implementation was pretty smooth and pretty successful when it happened last year. Although that did not come cheap, you know, with about a £3 billion price tag for the UK industry alone, with some of our larger members spending in the order of £500 million alone, which is just an extraordinary amount of money to transition to a new regime. I think that has resulted in better risk management. It probably has resulted in improved policyholder protection, but I really do question whether or not it was worth all of that cost. We have seen capital levels increasing, particularly in the life and long-term savings space, and think there is a real need to review that Pillar 3 reporting burden. I mean, as Sean says, we've sort of gone through the cycle once, but of course those timelines are still coming down for the next 3 years. So there's a need to continue to refine the operational aspects of that reporting going forward. What's been quite interesting for us, of course, is that Brexit presents a potential opportunity to scrap it all and start again. So that is a question which we've needed to come up with an answer to, and the short answer is that there isn't an appetite for, you know, fundamental reform again of Solvency II, and there's certainly no appetite for Solvency III. I think it is, broadly speaking, you know, fit for purpose for the UK market. It's a comprehensive, sophisticated, you know, risk-based regime, probably the most sophisticated in the world. And so our sort of mantra has been seeking to how we can refine it, you know, prune the bush, as Sean says, refine it, you know, rather than replace it.
And it's probably fair to say that there has been a bit of commentary which you get the two sides of around saying, well, actually the UK will come in and effectively look to regulatory arbitrage, so undercut and allow that. And then there's another school of thought that thinks, well, the PRA, you know, they'll want a gold plate, so actually it will be Solvency III rather than Solvency 1.5.
Yes, I think that's right. I mean, a lot of our concerns around about Solvency II at the moment are homegrown and relate to the PRA's implementation of it. You know, and it's perhaps natural with a new regime, but I feel as if they were they did err on the side of caution with their implementation, and I think that is another area which we would like to see looked at again. You're quite right, you know, Glenn, speaking to some of my counterparts across Europe, there is, I think, a genuine concern that the UK would seek to undercut and introduce that regulatory arbitrage. I just don't see that as very likely at all, and my concern is quite the opposite, that with the constraints off from the European framework, that there is a lot more flexibility for the Bank of England to to potentially ratchet things up again. And one of the things I would like to see is clear sort of UK parliamentary scrutiny and accountability around about the successor regime to try to prevent that in a way which I think the European Parliament has been quite effective doing through the development of Solvency II and Omnibus II.
Hey, Glenn, if I could just add here, I think the jury's still out whether the British government will take Brexit as a challenge or an opportunity, and I'm really leaning toward the opportunity side right now, and I'll tell you why. Last month, I attended the NAIC Spring National Meeting in Denver, Colorado, and the British government, this was unheard of, the British government brought an entire delegation to this meeting of state insurance regulators. Of course, they brought the PRA and the Bank of England, but also high-ranking British government officials, essentially coming to the states saying, we're ready to work with you on this regulatory relationship between the U.S. And the UK. And I really think they're going to take on the challenge as an opportunity of how do we make the markets better.
Yeah. But there's clearly going to be some tension between the different organs of the UK state in terms of the political will maybe against the regulatory will as part of that, Sean.
Yeah, in a way I hope you're right, John. I think we are a way away from where the US is in terms of having a question mark over do we want to start deregulating? So I think the noises we're seeing coming out of the Trump administration, the appointments that are being made are clearly towards scaling back. I think we are a way away from that, and I think Brexit is all-consuming for the UK government. There is a question, I think, for a number of jurisdictions around how regulatory agencies are framed in terms of their objectives. We have a number of regulatory agencies around the world who have a competitiveness objective within their statutes. And that, I think, is a challenge that needs to be faced because, I completely get the fact that you want a regulator that's utterly focused on ensuring policyholder protection and stability, but going to the point we were talking about earlier in terms of regulatory disharmony, if we have regulators out there very explicitly pursuing a competitiveness agenda, that's a challenge to a global organisation and to regulators who don't have that objective.
Yeah, and clearly that's a live discussion from an Irish perspective in terms of, moving from where we had a mandate, which was about the promotion of financial services for the central bank, to one where it's silent on, so there's no direct mandate, but that question of saying, well, actually there is still maybe a responsibility to ensure that, there's the common good of Ireland also within an overall mandate as part of it. I am getting lots of questions from Manuela here, so I do want to actually focus in.
Can I come back to me at some point on that?
I will, yeah. So picking up just on Solvency II straight away, the question coming from the floor here is does EIOPA believe that Solvency II in its current format is proportional and respects the nature, scale and complexity of companies? So that piece of the proportional application, and I think that has been a real struggle. We've seen that definitely in this Irish marketplace where there's the very small to the very large, the proportional piece. What's the sense from EIOPA around that?
No, I think it's inbuilt in the system. So everybody knows proportionality is part of Solvency II, and I think this is really important. So it's not about the regulation. It's now about how it's implemented. And this, I think, is also where Sean started off. We have done the regulation, so that means my job is done. And we are now going into supervision, and here we certainly need supervisory convergence. And proportionality is also part of this. And this is also one of the next main focus areas of EIOPA. So we will much more also go into how proportionality is implemented across Europe, and we will monitor it also quite closely, and we are currently starting to do the first analysis here as well. So I think that's really important. But it is part of the system. It needs to be applied. Also I can only encourage the firms to enter into a dialogue, a sound dialogue with their regulator, and also challenge the regulator.
The gauntlet has been put down there. And picking up generally on the activity of EIOPA around, I suppose, the review of Solvency II, and you know, we heard previously around, I suppose, the steps around SEO. Can you maybe outline for us actually where that process is in terms of the different phases of review and as that goes through the next couple of years?
Yeah. Now, I think what is important is we had really the first 5 years of EIOPA, or maybe the first 3 to 4 years, it was regulation. We really wanted to get Solvency II live. It was a very long process. Finally, we managed. I'm still incredibly happy about the preparatory phase, because that preparatory phase helped a lot on the ORSA part and also on the Pillar 3 on the reporting part. Yeah? I think that was a really excellent idea. So where are we now? We are now already being 18 months, around 18 months into Solvency II having gone live. We are already into the first review, which is the so-called standard formula review, so the SCR review, that was foreseen originally for 2020, and then thanks to the intervention of the industry, it was moved forward to 2018. This is where we are in, and I need to emphasize it's the standard formula, and that's important because sometimes it's really getting mixed up. The standard formula, we are doing it in 2 parts. I think that is also very, very important. We will deliver the first part of the advice to the Commission in October, at the end of October 2017, and we will deliver the next part end of February 2018. This was the end date that was given to us by the Commission, because the Commission needs more or less to deliver a regulatory adjustment amendment proposal by the end of 2018. To fulfill what is in the delegated acts. We also have recently established a work stream on catastrophe, cat risk. So here our task is first simplification. We are currently in the simplifications, in particular for the firms with a less complex risk profile. It's about thinking, can we merge for certain perils in certain countries? Can we merge, for example, crested zones? Or can we even have a factor for a country factor, which, you always need to see it from 2 sides, which then may not be ideal. If you have a different risk profile, if you don't have your risks spread across the country, you won't be happy about such kind of an average factor for a whole country. This is why we are thinking about introducing USPs for cat. There is a significant part of the market who may not be so overly happy to use USPs, but we think that this is really something where proportionality could really also come in and could help. So simplification is the first, recalibration is the second. So we have a list of 13 perils here that we are looking into recalibrating. Windstorm, earthquake, as you can imagine, but also flood, for example, which is very difficult. And then the last part, it's really also on the USP, which I already mentioned. So this is for the cut work stream. On the SCR review in itself, we have first it's simplification. Let's try to simplify. We got in our response, we got 1,000 pages of responses to our discussion paper, which we are analyzing currently. Sometimes we get proposals to become even more granular, and in particular in the cases where the standard formula is not reflecting the particular risk profile of certain countries or firms. So simplification is really important here. It's also proportionality principle that will guide us in the revision, and thirdly it's also about trying to avoid pro-cyclicality, because this is also a key point, and we are aware we need to find a balance overall. And I think this is a key message, because I heard some complaints about the general level of capital that is required by Solvency II. Overall, we are not striving to fundamentally change more or less the current capital requirements. We want to simplify, we want to recalibrate, but that is not going to release a massive amount of capital in the revision of the standard formula. That would be counterproductive, I also think. Yeah? It would also bring uncertainty to the market.
So the sense is more to make it more fit for purpose for
absolutely,
and more on the micro level.
Also operationally,
operationally.
yeah, make it also easier to apply operationally, because this is in particular also the feedback that we get from the less complex company, the small and medium-sized ones.
Yeah, and we have a number of questions here on exactly that point. Really, that piece of know that the Solvency II regulation really for those smaller entities is disproportionate in terms of all aspects of it, and that really is fighting against, I suppose, ensuring that we have those diversity of companies that we should have in place around those. So, just Gerry, I know you were just wanting to come in there on what Manuela was saying.
Yeah, and particularly, I think that's a very interesting conversation. And two things to pick up very briefly. One is, as John said, you are at a point in the cycle where there's the pendulum. You can see there's pressure for it to swing. I mean, our view is very clearly, and I think this is sort of along the lines of what Sean was describing. A huge amount of work has been done to get it pretty right. We learned a lot of lessons in the last 10 years, and an enormous amount of work has been done by all sides, to get us more or less into the right place. So what we should be doing is saying, where may things be a little bit wrong? Where do we need to recalibrate, simplify, all of that? But I absolutely agree, we should not be in this space of sort of, let's open this up, let's look for pushing that pendulum back. That would be the wrong space. Very important, the comments that were made about a competition mandate. First of all, important to distinguish between a competition mandate and a competitiveness mandate. So a competition mandate would be one which says, central bank, go out and promote Ireland as a jurisdiction. And we've seen very clearly in the crisis that leads you to perdition. You do not want for the central bank to have a promotion or a competition mandate. Separate to that is the question of what is the role of regulation in supporting the economy. Now, I don't think you need to have a new mandate, and indeed I recently made a speech in the University of Limerick about this. I don't think you need to have a new mandate to say that financial regulation is about regulating firms in such a way that they support the economy effectively. So you don't need to get into mandates, change of mandates to do that. That is the role of financial regulation. Of course it's about stability, of course it's about consumer protection, but it's about doing that in such a way that economic activity is supported. So I think in terms of promoting the jurisdiction, that's a role for others. That's something that you want your regulator to be doing. In terms of supporting the economy, then I think that getting the calibration of financial regulation right. Financial regulation is about regulating firms so that through consumer protection, calibration of regulation, confidence, you create an environment where economic activity is successful. So I think one needs to be very careful about calling for new mandates, because it leads you in very tricky directions.
Yeah, we are out of time just about. So unfortunately there was a number of other questions, and many of them directed at you, Gerry. But so you're probably lucky. So maybe I'll just say a final word from each panelist, maybe around, I suppose, what they think is maybe the buzzword or the hashtag word for 2017 and beyond. So, don't know, Sean, do you want to give me your
regulatory uncertainty continues, but maybe for different reasons. It's not a hashtag.
Not that catchy. I won't be putting out my T-shirt. Stephen?
I think we need to make sure that regulations reflect the diversity in different markets, be it products, social models, and so on, but do that in a way which involves regulators having a close dialogue with each other, so we can continue slowly on a journey to converge at some point.
I'm going to take it a completely different way. Hashtag private flood insurance. It's the #1 opportunity for the P&C market in the U.S. and around the world.
Very good. Gerry?
So I think in the context of what we're seeing globally and in Europe and Brexit, I would say focusing on mutual understanding to get optimal outcomes would be my sense of it.
Good. Manuela, you get the final word.
I get the hashtag style, so supervisory convergence and make proportionality work.
Very good. So I'd like to thank all of my panellists, and if you can thank them in the traditional way. Thank you.